All right, before we jump in, a quick but important note. Disclaimer. This report is a personal investment research note prepared solely for private use by Stressfree Investing. It's not financial advice and it's not a SEBI-registered research report. The author might even hold a position in the stock we're talking about. Remember, past performance doesn't guarantee future results, and all investing has risks. So please consult a SEBI-registered investment advisor before making any decisions. Okay, let's get into it.
So let's start with the big, glaring number. HDFC Life. You know the name. It's an absolute giant, a top-tier player in India's insurance space. And yet, the stock has been hammered, down 31% from its 52-week high. I mean, wow. A drop like that for a blue-chip company, it definitely gets you thinking. And that really brings us to the heart of the matter, doesn't it? Is this a falling knife, a sign of deep, fundamental problems that you absolutely do not want to touch? Or is it a coiled spring? Has the market overreacted, pushing a great company down so far that it's just waiting for the right moment to snap back? That's the mystery we're going to unravel today. Okay, let's frame this whole discussion. The basic situation is right here in the title. We have a market leader, a best-in-class company that is trading at a serious low. This section is all about setting the stage and looking at the main conclusion from the research note we're digging into. And you know what? The report doesn't make you wait till the end for the answer. The verdict is straight up: accumulate. Yeah, despite all that fear in the market, the analysis suggests a base case fair value of about 720 rupees per share. Now, from where the stock is today, that's a potential upside of 31%. So the report is making a clear bet here. This is a coiled spring. So how can you be so bullish when the stock chart looks so, well, scary? The whole investment case really stands on three core pillars. These aren't about market sentiment. They're about the fundamental strengths of HDFC Life's business itself. Let's break them down. Here they are, the big three. First, what the report calls a dominant distribution moat, basically a massive competitive advantage. Second, the fact that this company is a proven compounding machine. And third, you can get all of this quality at a valuation that is, by its own standards, historically cheap. Okay, let's dig into that first pillar, the moat. HDFC Life is the #2 private insurer in India. That alone is impressive, with almost a 16% market share. But the real secret sauce, the thing that's almost impossible for anyone else to copy, is its access to over 9,000 HDFC Bank branches. Just think about that. In a country where financial products are sold on trust, that is a golden highway straight to the customer. Now, before we hit the second pillar, we have to quickly get our heads around a key idea for any insurance company: embedded value, or EV. Don't worry, the jargon's not that complicated. The best way to think of it is as the company's treasure chest. It's the value of all the future profits from the policies they have already sold. It's value that's essentially locked in. So why does that treasure chest matter so much? Well, look at how fast it's been growing. Over the last 5 years, HDFC Life has grown its embedded value by an average of 18% per year. That's not a one-off. That is a high-quality compounding machine in action, consistently building its underlying worth at an incredible pace. Okay, so we've got this amazing growing treasure chest. How do we know if we're getting a good deal on it when we buy the stock? That brings us to our third pillar, and the main tool for valuation, the price-to-embedded value ratio, or PTEV. It's simple, really. It just tells you how many rupees the stock market is asking you to pay for every 1 rupee of that locked-in value. Lower is cheaper. And this slide, right here, shows you the opportunity in black and white. Right now, the stock is trading at a PEV of around 2.2. But if you look at its own history, its 5-year average is up around 3. The market has slammed the brakes on its valuation, giving you a chance to buy this incredible compounder at a massive discount to where it normally trades. But, of course, a stock doesn't get this cheap for no reason. The market isn't stupid, it's scared. And to build a credible case, we have to stare those fears right in the face. So what exactly is it that has everyone so spooked about HDFC Life? Well, the research note boils it down to these top 3 worries. First, there's pressure on the profitability of the new policies they're selling. Second, it seems like the regulators are getting more and more involved. And third, the company has a pretty high concentration in one specific product type called ULIPs. Let's look at that third risk a little closer. This chart shows you the breakdown. ULIPs, those are the unit-linked plans tied to the stock market, make up a huge 39% of new business. And the big fear there is pretty obvious, right? If the stock market hits a rough patch, sales of these products could dry up fast, and that would really hurt growth. So what's the counter-argument? How is the company dealing with this? Well, the report points directly to the management's own words. they're seeing a sharp pickup in their pure risk, high margin protection business. You can see it right there. It grew 20% year over year. By doing this, they're actively diversifying away from ULIPs and boosting their overall profitability at the same time. So that brings us to the grand finale. We've seen the powerful bull case, the moat, the compounding, and we've looked at the very real fears that are weighing on the stock. When you put all of that together, what kind of bet are you actually making? According to this report, it's a pretty special one. This table lays it out perfectly. The analysis projects 3 scenarios. In the bear case, if things go badly, the potential downside from here is only about 6%. But in the base case, just a return to normal, you're looking at a 31% upside. And in the bull case, if things go really well, a massive 57% potential gain. And if you want to boil that entire table down to a single number, this is it, 5.2. That's the reward to risk ratio. For every 1 rupee of potential loss in the worst case scenario, you have over 5 rupees of potential gain in the base scenario. That, my friends, is what investors call an asymmetric bet. The upside dramatically outweighs the downside.
And so we end right back where we started, with one powerful central question. Is the market seeing things clearly, or is it taking temporary problems, some regulatory changes, a shift in product mix, and mispricing them as if they are permanent, irreversible damage to this incredible business? The answer to that question is the entire investment thesis.
The full report is in the description. If you want more deep dives like this, definitely like and subscribe. Most importantly, what stock should I look at next? Drop your suggestions in the comments below. Signing off, this is Stress-Free Investing for now. And hey, if you liked this report, I'm sure you'll also enjoy the analysis on TCS and other stocks in my playlist, Stock Specific Analysis.